Gold closed at $4,676 yesterday. This morning, the March jobs report landed 65,000 jobs added, following a devastating February contraction of negative 92,000. Markets are closed today for Good Friday, but the smart money is not resting. And by the time you finish this video, you will know exactly what that jobs number means for gold. What happens when markets open Monday, and why JPMorgan, Goldman Sachs, and Wells Fargo are all pointing at the same number before December. Stay with me, because the single most important data point that decides where gold goes next comes in the second half of this video, and most people watching right now will never hear it anywhere else. 3 months ago, gold was at $5,595, the highest price in human history. Then it crashed 23% in 60 days. Retail investors panicked. Every comment section on every financial channel declared the bull market finished. And the question that dominated markets for 2 months straight was simple. Is gold broken? Goldman Sachs answered that question on March 31st, 4 days ago. They kept their year-end target at $5,400 per ounce. They did not lower it by $1. Called the crash an overshoot, a market that repriced too hard, too fast, and got ahead of itself. And they said that the underlying forces that drove gold from 3,000 to 5,500 had not changed by a single variable. That statement matters more than any price on any chart right now. But before I show you why Goldman was right, you need to understand what actually caused the crash, because the explanation you heard everywhere else was wrong. 3 forces hit gold simultaneously in March, and the combination was violent. The Federal Reserve on March 18th cut its 2026 rate cut projections from 2 cuts down to 1 after. February producer inflation printed at 0.7%, the strongest monthly number since mid to 2025. That removed a rate cut premium that gold had already priced in. The 10-year Treasury yield jumped to 4.4% overnight. At that yield, cash pays real returns and gold pays nothing. The opportunity cost of holding bullion doubled in a single session. The exact same moment, the U.S. dollar index climbed to its strongest level since May 2025, as safe haven flows reflexively moved into dollar assets because of the Iran war, which pushed dollar-denominated gold down further, while the Fed news was still hitting. 2 blows in the same hour? Then the third force, the one nobody explained properly, is the one that turned a correction into a crash. At the January all-time high, speculative long positions in gold futures were near record levels. When selling started, margin calls triggered. Leveraged investors did not sell because they wanted to. Their brokers forced them out. That mechanical liquidation has one defining characteristic. It ends the moment the last forced seller is done, not when inflation falls, not when the Fed cuts, when the margin calls stop. The data from the first week of April tells us they stopped. Gold rose for 4 consecutive sessions to open April. April 1st alone saw a 3.5% single-day gain, the largest daily advance since late January. That is not a dead bull market. That is a market that cleared its excess positioning and started repricing toward fair value. Now here's the number I told you was coming, the one that changes how you read everything else in this video. Central bank purchases averaged 27 tons per month through all of 2025. In January 2026, that fell to 5 tons, and the retail narrative was instant. Central banks are exiting, the structural bid is gone, gold is over. That narrative is factually wrong. JPMorgan's data shows that when gold trades above $4,000 per ounce, central banks do not need to buy as many tons to move their allocation to the desired percentage. The slowing tonnage was a mathematical consequence of the price being high, not a strategy change. China continued adding. India continued adding. Malaysia and South Korea, which had been inactive for years, resumed buying and had not stopped. These are governments deciding where to store national wealth for the next generation. They do not reverse those decisions because of a 2-month price correction driven by margin calls. Now this morning's jobs number, 65,000 in March, following negative 92,000 in February, is what the gold market has been waiting for? TD Securities global commodity strategist Bart Melek said it directly this week: poor job creation. Higher oil prices from the Iran war, uncertainty, and an easing Fed are all a combination for precious metals. The 65,000 print is what analysts call a Goldilocks number, strong enough to keep the Fed from cutting immediately. but weak enough to keep recession fears alive. That second part is what matters for gold. When recession risk is on the table, the Fed cannot hold rates high forever, regardless of inflation. Goldman Sachs and JPMorgan are both projecting the Fed signals a pivot by the second or third quarter of 2026. When that happens, the dollar weakens, real yields fall, and gold does not just recover, it accelerates. Historically, in the 4 months after the first Fed rate cut, gold rises an average of 6% from whatever price it starts at. From $4,676, that math points significantly higher. Here is the structural case that sits underneath all of this, and that no short-term price move can change. 80% of all U.S. dollars in existence have been printed since 2020. The national debt crossed $39 trillion on March 18, 2026. The Congressional Budget Office projects a deficit of $1.9 trillion this year alone. Tariffs generate roughly $360 billion. The gap is $1.5 trillion that must be borrowed or printed. That equation was the same when gold was at $3,000. It was the same at $5,595. It is the same at $4,676 today. Gold cannot be printed. Every dollar that is printed to fill that gap makes every existing dollar worth slightly less, and every ounce of gold worth slightly more. Ray Dalio built his entire macro framework around this reality. He said monetary systems do not collapse in one dramatic moment. They weaken slowly through decisions that each seem manageable on their own, until one day the trust is gone. The 23% crash was not the trust coming back. It was a technical event inside a structural shift that is decades in the making. From current prices, Goldman Sachs targets 15% upside by year-end. JPMorgan at 6,300 implies 35%. Wells Fargo at 6,100 to 6,300 implies 38 to 43%. UBS at 6,200. Bank of America at 6,000. Every major institution on this planet kept their targets unchanged or raised them through a 23% crash. That does not happen when a bull market ends. That happens when institutions see exactly the entry they were waiting for. Monday markets open with the 65,000 jobs print fully digested, Good Friday liquidity gaps closed, and a gold price sitting 35% below where the largest bank on Wall Street says it will be by December. The crash was not the end. The crash was the setup. Subscribe to Crisis Alpha right now because next week I am covering exactly what the Monday open means for gold and what the Fed's next statement does to the trajectory towards 6,000. If you are not subscribed, you will miss that analysis before the move happens. Hit subscribe and turn on notifications right now. You think gold bottomed this week and the recovery towards 6,000 is already underway? Or do you think the 65,000 jobs number gives the Fed enough cover to hold rates and push gold back toward 4,000? Drop your answer in the comments. I read every single one, and I will personally respond to the strongest arguments on both sides. And if you want the full picture on why the dollar is losing reserve currency status and what it means for every asset you own, that video is on your screen right now. Click it.